The president declared that both GSEs will be taken public with implicit guarantees intact. Almost simultaneously, the new Treasury Secretary, Scott Bessent, reminded reporters that any plan proceeds only if mortgage spreads, the difference between the rate on the GSE-backed loans and a risk-free Treasury, stay put. Translation: privatization, yes. Raise mortgage costs, no. It's a delicate balance because economists like Moody's Mark Zandi estimate returning to a purely implicit guarantee could nudge 30-year rates up 20 to 40 basis points, roughly 0.25%. On a $400,000 mortgage, that's $60 to $100 each month. Not life-changing for some borrowers for sure, but a disqualifier for others already stretched by high prices and tight inventories. Why might rates rise at all? Remember that investors buy Fannie and Freddie-backed mortgage-backed securities because they trust the credit quality and, in practice, the government's untarnished record of stepping in. Under conservatorship, the backing is functionally explicit. Treasury stands directly behind the bonds, and the Federal Reserve is willing to purchase them in a crisis. Once the GSEs leave the nest, investors have to decide how much they trust an implicit promise. If they demand even a sliver more yield to compensate for the uncertainties, lenders are going to certainly pass that extra cost to the borrowers. We are going to be the ones that pay for it, no doubt about it. Treasury can try to offset that with lower guarantee fees, but there is no free lunch. Someone, borrower, taxpayer, or shareholder, has to absorb the risk premium. And there is risk. To exit conservatorship, Fannie and Freddie must raise somewhere north of $200 billion in fresh equity to meet modern capital standards.